Well, as we've been talking about, equity futures pretty much unchanged as traders await for what the Fed is going to do and whether Operation Twist is going to be a go. With us is BlackRock's Rieder. He oversees more than $600 billion, 1/6 of BlackRock's $3.7 trillion in assets. And of course, John and Dominic here with us as well. And Rick, just curious, how are you positioning yourself ahead of this?
Yeah, I mean, I think the market expectations for Operation Twist, and I think people are expecting you're going to get some form of sell the front end to buy the back end, and I think everybody's honing in on this $300 billion. So we don't think that impacts markets dramatically. We've been incrementally adding a bit of risk assets, and we think there is a likelihood, potential, over the next few months that maybe you get balance sheet expansion. And I actually didn't think that a while ago, but we're actually starting to think that maybe that's out there. So one of the things that we spent a bunch of time thinking about, what was QE1 and what was QE2? And one of the things that became pretty obvious is it dulled liquidity, it dulled volatility in the markets. When you go back and track what happened, and no doubt it created more of a bifurcated economy, it definitely had an impact on commodity prices. The other influence that people don't realize is because of growth of foreign exchange reserves around the world that pivots off of QE2, QE1, QE2, it actually dulls volatility in the marketplace.
Okay.
If you're going to execute some form of structural change in the U.S. and in Europe, well, you want to keep that left tail risk down. So I actually think I don't think it's a today event, but I actually think it may happen over the coming months now.
So if you do that, if you dull volatility, if you give the markets a chance to kind of, give them a stable base to grow from, at what point does the market really take off? I mean, we saw no QE right now per se, right? No balance sheet expansion, and we saw what we saw over the past 3 months, which is not unprecedented, but huge market volatility, the likes we haven't seen since the financial crisis. So what does it do? I mean, ultimately, do we damp volatility? Does it mean it goes higher or lower from here?
I think people misinterpreted QE2, and I think a lot of the discussion was when the Fed stops buying treasuries, rates have to shoot higher because it's not going to be a buyer. I actually think it was flat wrong. I actually think what it does, because it creates this multiplier effect around the world, at 600 and change billion, created $1.7 trillion of liquidity around the world. That goes into all financial assets, commodities, equities, high yield, loans, et cetera. And what it does is it tends to dampen this volatility. And it's pretty, so I don't know that it necessarily causes a rocket higher of financial assets. But the thing that the markets really would like to see is a dulling of that left tail, the fat tail risk on the left. And that's something that's really important. And by the way, we need to have structural change, both in Europe and the U.S. The thing that would help is if the markets were a bit more stable in the interim.
So let's simplify this for the average investor. You think, based on that outlook, that people are going to be willing to buy corporate bonds and stocks into the end of the year and maybe be less buying treasury? I mean, we had David Kelly of JP Morgan earlier this week, and he said at some point people are going to get burned badly by buying 10 years with a yield below 2%.
I think that's fair. I mean, by the way, I don't think risk has gone away. I think risk is still, there are three main risks that are out there. The emerging market growth slowdown, China. We don't think it's a hard landing, but slowdown. That risk is not going away. But we think it's a moderation. U.S. growth clearly is still a risk that's out there, and that's the data that's coming out today is mixed. It's not all terrible, but it's mixed. Europe's a big one, and Europe is not going away anytime soon, and you need to have structural change in Europe, and the back and forth headlines are not going to go away. So we've been adding risk incrementally, but we're still pretty conservative in positioning because we would like to see some closure, particularly to Europe.
So then, Rick, what you're saying is that if this works, if this dulls the volatility, then would you say Operation Twist, if it happens, would be a success?
I do. I mean, I think there's an interesting, so I think Operation Twist is coming, and I think the market thinks it's coming. But it's interesting to see if you actually expanded your balance sheet after it. Usually what that does is creates higher inflation expectations, hits the back end of the curve. But if actually you're taking the supply to the back end of the curve through twisting, actually maybe you're not actually going to hurt the back end. So we'll see what the comments are today, and I don't think you get that aggressive statement or you get a statement about balance sheet expansion, but maybe talk about the tools that are out there.
And Rick, I just want to ask you, I mean, you said you've been buying risk assets, right? So tell us specifically where you've been buying.
Slowly. I mean, I still, the point I made earlier is risk is still very much out there, largely out of Europe, but there's still a multitude of risks that are out there. So we're slowly adding to positions. I mean, one of the things we try and be ahead of the market, especially in some of our portfolios. If we think things will start stabilizing and improving, even if it's 2 weeks, 3 weeks hence, we'll start adding. So there are a couple of things. We like the high yield market, and we think yields there. You're talking high yield now, 8.5%. Boy, if we think interest rates, which I do, I think interest rates are going to stay low for a long period of time. If that's right, I'm not sure the 10 years is going to stay at a 193 yield forever. But if we're going to stay in the twos type of yield, 8.5% yield, unless you think the economy is really dipping into recession, we think is attractive. So high yield, leverage loans. We actually started last couple of weeks adding a bit to financials. And we think, some of the pressure in Europe as well as the U.S. in financials, banks, insurance companies.
In the U.S. financials?
Both U.S. and Europe.
Okay.
But in the same thing in a very iterative way. But some of those valuations have become very attractive in this volatility.
What about technology? Everybody talks about how tech companies have a mountain of cash, and overnight Microsoft said we're going to boost our dividends. So stock investors understand, they're going to get a bigger dividend from Microsoft, even if the stock isn't moving. But you talked about in the high yield market yields of 8-9%. I mean, the yield on Microsoft shares, even with the dividend boost, is like 3%. So do you like owning the bonds tied to tech companies since they have a lot of cash, and if they choose to issue debt, they can pay it off?
So I like, and we as a firm like getting income, and we think for the next, you're going to be in a slow growth dynamic, I think, in the world for the next couple of 3 years. And if the developed world is going to grow at 1-ish%, it's going to be pretty hard to generate a lot of return from upside appreciation. So we look for all places to get income. I would argue dividend yields are very attractive, for sure. Dividend yields, preferreds, high yield loans, the ability, and we talked a bit at break about demographic change in the world, and you have this aging population, not only an aging population, but the actually life expectancy of people has extended in the last 50 years, has extended 13 years.
So Rick,
people need yield.
Well, let's take that. Let's take that demographic focus and say, let's take it back to where it hits Main Street.
Sure.
If investors are out there, you're a big money manager.
Sure.
Where are you telling people to put their money?
Yeah, I think getting income is going to be very important. You can go through periods of high risk like we've been through in the last 2 to 3 months, but I still think there's going to be a need to get yield and a need to get income. And so asset classes that we think that provide opportunity to get you yield makes sense. So we talk about high yield loans. Part of the asset-backed market is attractive today. That's backed up. On the back end of the curve, where there's still, depending on what Operation Twist does, there's still yield in the long end of the curve. We like things like long municipals, like investment-grade credit that gets you enough yield in the back end. And we think credit quality in a lot of the municipal market, investment-grade market is rock solid.
Right.
And we think you still get some yield out there.
Rick, thank you.